Thank you for joining us this Friday, the 1st of July, and Happy New Financial Year. I'm Sophia, a market analyst with Bell Direct, and this is the weekly market update. Well, the closing bell rang on the 2022 financial year yesterday with a record loss, as investors incurred a negative return for only the third time in the past decade. The ASX 200 closed the financial year with a loss of 10.2%. This is in comparison to the impressive 24% return the market had the 2021 financial year. The market's sharp declines are mostly a reaction to the central bank's aggressive take on monetary policy and the flow-on impact on consumers. As well as inflationary pressures, we've also seen supply and demand imbalances in commodity prices, particularly in oil. And the four major banks this year disappointed investors as well. It was expected financials would outperform in an environment of rising interest rates. However, the financial sector dropped 11% this financial year. The worst sectors this year were tech, down 39%, and the consumer discretionary sector, down 23%. The best performing sectors were utilities, up 29%, and energy, up 25%. As for stock performance this year, AVZ Minerals made the most gains on the ASX 200, advancing 388%. And Core Lithium, CXO, and Whitehaven Coal, WHC, also both gained 300% and 149%. Meanwhile, the stocks that suffered the worst losses were BNPL companies Zip, PointsBet, PBH, and Magellan Financial, MFG. Now, as the financial year wrapped up this week, many investors rebalanced their portfolios to sell down those stocks that have done well and to buy stocks that have underperformed. So stocks that have gained this past year likely to see some profit taking, and it's the last week for fund managers to bring their asset allocations back to target. So in the market's performance this week so far, resources stocks are in high demand, while real estate and tech have experienced sell-offs. Evolution Mining, EVN, has dropped 30% this week after announcing its production for this financial year is expected to be lower than last year and costs will come in higher. And other major gold miners dropped as well, including Regis Resources, RRL, Northern Star, NST, Ramelius Resources, RMS, and St. Barbara, SBM. On the other hand, Collins Foods, CKF, performed best after announcing robust sales and earnings growth. The most traded stocks by Bell Direct clients were Sims, SGM, Beach Energy, BPT, Link Administration, LNK, Treasury Wine Estates, TWE, Rio Tinto, RIO, and ANZ. Clients also bought into Wesfarmers, WES, and Woolworths, WOW, while took profits from Westpac, WBC, and CSL. And the most traded ETFs this week were the Vanguard US Total Market Shares ETF, VTS, the BetaShares Strong Bear Hedge Fund, BBOZ, and the BetaShares Geared Australian Equity Hedge Fund, GEAR. And lastly, economic data to look out for next week. As we know, the RBA meets on the first Tuesday of every month, so on Tuesday the central bank will have its July meeting, where they'll announce the next interest rate decision. Last month, the RBA raised the cash rate to 0.85% as the board stated that huge monetary support is no longer required for the current state of the economy and the current inflation pressures. Now, the RBA is expected to raise rates further on Tuesday. So when we look at the factors contributing to the strength of our economy currently, the labour market is strong with growth in employment and the jobless rate is at its lowest level in almost 50 years. So the RBA are now trying to ensure that inflation returns back down to target while paying attention to the global outlook. So global factors include the prices of energy and commodities and the Ukraine war. Market forecasts expect the cash rate to be raised to 1.35%. Also on Thursday, balance of trade data for May will be released. So this will highlight Australia's trade surplus for the month of May with data on how much imports and exports increased and decreased. And that's all we have time for this week. I'm Sophia with Bell Direct. Have a great Friday and enjoy your weekend.